Hi, everyone, and happy Friday. This is Marie from MarketsFlow. It's the 27th of September, and we're recording this 2 hours before the close on Friday as we bring you this weekly performance for the week ending September 27th, 2019. I'm here with Adam. How has your day been, Adam?
It's I've had a good supply of food and coffee. Interesting markets to grapple with. Things could be worse.
That's right. Doesn't sound bad at all. So let's get started. This is Webcast 22 for MarketsFlow's portfolio performance for week ending September 27th. Our podcast is recorded every Friday and is uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's available. MarketsFlow is an FCA authorized robo-advisor and digital wealth manager. We are also SEC authorized. Your deposits are protected by the FSCS for up to £85,000. Before we start, I would like to run through our disclosure. Your capital is at risk, and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. So having said this, let's cover the important subject of how did the portfolios do this week.
Well, up to now, and as you said, we're part way through Friday as we speak, with some hours to go before market close. And so as at that moment in time, high growth is up 0.16% this week, up 5.56 since the launch of accessible portfolios at the start of June. For the growth portfolio, the respective numbers are 0.39% and 5.69%. And for the ISA, 0.33 and 3.56.
And how has the market as a whole performed this week?
Well, at about, where are we? Sort of lunchtime, New York time, so halfway through the session. The market was down about 0.75%, measured as we usually do from the previous Friday's close. So the market has spent the week going up and down in very small daily increments up until the end of yesterday, Thursday. By that point, it had drifted overall downwards, but with this very small moves, and come off overall about 0.25% in those 4 days. And then everything else that goes into the 0.76, I think we were at, has happened today. And it's been a much more action-packed session than even that figure would imply. So much so that we've seen implied volatility jump up from above 17 this afternoon. So not back up to the stress levels that we had a couple of times in August, but also not as calm as we became accustomed to in June and July. And these numbers, as I've said, both for portfolios and market for the week so far, we're talking about something like midway or slightly more than midway through the Friday session, and it's been a more volatile day than most. So I'd point out the possibility that from here to the end of the day, there could be some variation from that.
So what about allocation within the portfolios? Presumably that is directly affected by the sort of market conditions you just described?
Well, yes, exactly. It certainly is. And this week we've been a little more lightly allocated than last week. In other words, less fully invested. We've also been quick by necessity in our moves in and out of holdings, as we've frequently seen what appear to be the beginning of a stock or the market as a whole taking a decisive direction, but then it flakes out after not going very far, and then often ends up reversing back to where you started. So if you'd gone in and not taken the opportunity to bank the gains you'd made, then you could easily have been too late and being turned back to where you began. Very frustrating to be in markets like that, but the answer is that if you can, to be agile and to be not too demanding in terms of the amount of return that you expect each invested position to make for you. And then to compensate for the fact that each position isn't going to produce very much, because that's what you're in for. If you acknowledge that these are small, brief holding periods, and you're not going to set your limits too ambitiously, otherwise you won't make them. To compensate for each position only doing a little for your return, you've got to take them more frequently so that there can be more of them per period, but only to the extent that they're still quality trades that you've had the chance to think about in terms of the rationale and make sure that they're, in harmony with our indicators. So there's a balance to be struck there by wanting as many potentially money-making positions put on in a portfolio as you can have each week, say, or each month. But if you're starting from the top of the list in terms of priority, the trades that you really believe in first and foremost, and then working your way down, the greater the number of them you engage in, the further down the list you have to go. And if that list runs, as I've said, in declining order of risk-adjusted returns, then you're starting to include positions that you aren't so convinced about or that aren't such quality. So quality first and foremost ahead of quantity for us. So it's a market that can be traded. It's just a little more challenging, requires different techniques. And just to round up, we've just complete that. We also did very little in terms of options this week. Almost everything it was in stocks only.
And what do we look forward to from here over the next week or two, Adam?
Well, I mean, there are plenty of stories clearly that are going around and continuing to develop in the geopolitics space, and that are evolving from day to day, and each with the potential to move markets. And suddenly, now that we're on the border of October, it's started to feel as if Brexit's quite imminent. The UK's planned exit from the EU, that's only about a month now. Or if it isn't going to happen on that date, then an extension must be requested some weeks, I think 2 weeks before the end of October happens. But of course, a very key debate that's probably more important for the markets we follow than that is how much more monetary easing is going to be provided by the Fed. It's also an interesting fact to note that just over 50% of all the world's central banks have eased rather than tightened overall over the last 6 months, which is a change relative to the previous 6. Also, there's another issue that's popped up more recently. There are concerns about the health of money markets right now, given the amount of intervention in operations that the Federal Reserve is having to undertake to help supply and demand come in balance for short-term instruments without, wanting to avoid those sudden spikes in short rates. And on the economic front, again, next week we have various key Fed policymakers giving speeches, the release of both ISMs, and on Friday, being the first Friday of the month, the release of the payrolls report. So quite a big week for the US economy if you're looking for places to try and pick up hints as to where things may be headed from here. And as we look a little bit further out, we're just a few weeks away from being immersed in Q3 earnings season. So plenty to get into.
So that brings us to the end of our podcast. Thank you for watching or listening to us on YouTube. Thank you, Adam, for all the information you provided. And please remember to subscribe to our channel. Have a great weekend, and we look forward to our next Friday's podcast. Take care.